how are you doing today? I hope you're having a wonderful day. Now, before you sign those mortgage papers, you need to know that picking the wrong type of loan is the #1 way why first-time home buyers lose money in today's market. You've heard all the details before: FHA, VA, conventional, fixed rate. But what you don't know is the one that you pick can make a big difference on your bottom line. By the end of this video, you won't just know the difference, you'll know exactly which one is the better deal for your specific wallet. So let's get started. Let's start out by talking about a couple different types of loans. The FHA loan is essentially a government's way of saying, we got your back. It's insured by the Federal Housing Administration, therefore an FHA loan. So it makes it much less risky for banks to loan you that money. So the biggest perk is you can get in with a low credit score, probably around 580, and you only have to put 3.5% down as your down payment. It also gives you that safety net, and it's designed for people who have a little more debt and a little less perfect credit history, and that's why you have a lower credit score. Now, in reality, it's accessible, but that accessibility comes with a price tag, and we'll talk more about that in a minute. Now, to give you some round numbers of what I just talked about in the percentages. So if you're buying a home, that's approximately $100,000. If you're putting 3.5% down, that's $3,500 for your down payment. Now, in addition to that, you're going to have closing costs. A seller can pay up to 6%, so that's roughly about what your closing costs are going to be. So on a $100,000 loan, that's going to be $6,000. So altogether, that's $9,500, almost 10% of that purchase price of your loan. Most often, like I said, the sellers can pay for those closing costs, but in reality, that means you're including it in your loan. So you're still going to pay it, you're just not paying it up front, which means you're also paying interest on it. But that way, at least you have some options. Another type of loan is called a conventional loan. If you look at FHA like an entry-level model, then the conventional loan is the upgrade. Now, it's not backed by the government, so you need a little bit more to get in. You're not going to automatically be on the invite list. It's a little more exclusive. Now, the standard usually is that you're looking at a little bit higher credit score, probably in the 600s versus the 500s, or maybe even 640 versus the FHA loans. You have to have a little bit better credit, so that's why everybody can't get one. Now, most people think you need 20% down for a conventional loan, but that's really not true. You can do it for much less. I usually see people say around 5%, but they do have first-time home buyer programs as low as 3% down, and that's less than the FHA loan. So it's got some good and bads. Now, the benefits, it's kind of a cleaner loan. When a seller sees a conventional loan, they're like, okay, we just got to get through an appraisal. But if you see an FHA loan, they know that there's more hoops to jump through. You'll also have less closing costs with the conventional loan as a buyer, probably as a seller as well, because there's less government involvement. Now, a credit score is where the math. Now, when it comes to your credit score, this is where the math really starts to matter. If your credit score is really great, like let's say 740 or higher, then a conventional loan is almost always going to win because your interest rate is going to be lower and your private mortgage insurance will be dirt cheap. But if you're a little bit lower, closer like the mid-600s range for your credit score, that conventional loans gets a little bit more expensive. So in that bracket, that FHA often offers a much lower interest rate than a conventional loan would for the same person. So that's why it's important to talk to your loan officer as well as your real estate agent to see what's going to be best for the home, for you, and for you to get your best money out of the property and not have to pay as much interest as well as a PMI mortgage. I mentioned PMI, that's primary mortgage insurance, and that's basically the insurance against you foreclosing on your loan because you don't have much equity because you're putting less than the down payment that they really like you to have. So it does matter though between the FHA and the conventional. Both loans usually require mortgage insurance when you put 3 or 5 or 3.5% down, but they work a little bit differently. For example, the FHA loan, it is for the life of the loan. The only reason that you can get rid of it is if you refinance your home. So are you going to be able to refinance your home when you get 20% in? Maybe, maybe not. Maybe you'll want to sell it at that point, so it might not even matter to you. It also, on an FHA loan call, costs 1.75% upfront. So you have to pay that. That's another closing cost that you're going to have to pay along with all your other costs to get the loan. And it's a little less flexible with a conventional loan, where with an FHA loan, they have the same rate for pretty much everybody, because most people that are getting an FHA loan are pretty much within the same measures of credit score and debt to income and things like that. So they have a pretty standard rate, plus it's backed by the government, so that helps with the primary mortgage insurance. However, on a conventional loan, all you have to do is get that 20% equity in your home, and that PMI goes away. So you don't have to worry about it. I mean, you're going to want to watch it and make sure that they actually take that off. Your payment actually will go down for once. The only time your payment's going to go down is if you get rid of that primary mortgage insurance. That doesn't cost anything up front with a conventional loan, but the rates for that mortgage insurance are going to be based on your credit score. So it could be higher or lower, but if you're going with a conventional loan, more than likely you're going to have pretty good credit score, so it's probably going to be less than the FHA. So that is an important part of it, along with your down payment and your closing costs. There's also that mortgage insurance that is going to cost you some money. If you're finding this breakdown helpful and want to master the 2026 real estate game, hit that subscribe button right now. I drop deep dives like this every week to make sure you're the smartest person at the closing table. Now, the better loan isn't just about the money. It's about getting the house. You want to make sure that the house that you get appraises. Now, one thing about FHA loans is appraisals are notorious for being strict, and that's why sellers don't necessarily like FHA loans. They check for peeling paints, handrails on the stairs, specific safety hazards. Is the roof going to leak within 5 years? Is the heat and air working? So it's a health and quality safety inspection that's done in conjunction with the appraisal. It's not an inspection. It just makes sure that the absolute basics are taken care of. So if you are looking at a fixer-upper, an FHA appraiser might flag things that the seller refuses to fix. So you're going to want to know ahead of time if your agent or your seller is able to tell if it would qualify for FHA, as well as if the seller is going to make any repairs at all, or you got to take care of everything. On the other hand, a conventional appraisal is just pretty much focused on the value of the home, rather than any minor details or repairs that the appraisals may be like, is that safe? If the house needs work, a conventional loan is going to be best friend if you can't do a cash purchase. But I will make a note here, there is a special type of loan called an FHA 403k type of loan. You want to check with your lender if you're wanting to get a fixer-upper or a foreclosure and you don't have a lot of money to do a down payment and you can't get a conventional loan. There are options available, but there's a lot of detail that I don't know. Like you have to use certain contractors, you have to check the box just right to get that type of loan to work, and you may not want to jump through those hoops either. But just want to let you know that that option is available. How much life do you have in your budget? FHA is much more forgiving if you have student loans or car payments. They often allow for a debt-to-income ratio of up to 50% or higher in some cases. Now, a debt-to-income ratio is the difference between your income and your debt. So if you have, just random numbers, your income is $100,000, that's my favorite number apparently, and you have a car loan and you have student loans and you have a credit card and now you're getting a house, all of that is your debt. So it includes the house that you're going to purchase as well as the debt that you have now. And it has to be a certain percentage for them to give you a loan on it. So with FHA, they can go a little bit higher, but conventional lenders are usually a little bit tighter because they don't have that government backing. They're taking more risk on you as a buyer. So they usually like you to be under 40%. So you've got some debt, but a steady income, FHA would be the better way to go. But if you have less debt, and maybe don't even have that great an income, but definitely a better debt to income ratio, conventional is going to be the way. So, and again, the lender is going to give you an idea of what loan is best for you, but this just helps you going in to what you should be looking for when you talk to them and what options are available to you. And there are more loans available other than FHA and conventional. So which one is better? You're probably going to want to go towards an FHA loan if your credit score isn't great, maybe have a little bit of debt, and you need the most forgiving interest rate because you're going to have a higher loan when you put your closing costs in your loan. If you can go towards the conventional loan, you might have a higher interest rate. You want to be able to just get rid of that mortgage insurance without refinancing. And you want your offer to look stronger for the seller. They don't want to have to worry about a bunch of repairs and all the nitpicking that comes with an FHA appraisal. They want to be done with it and move on. But there is no one size fits all, but there is one size fits your wallet. So take a look at your score, look at your savings, make the move that builds your wealth, not the banks. You want to find a way to get rid of that interest whatever way possible. Now, if you want more information about the buying process, loans, down payment assistance, all that kind of stuff is in my buyers playlist. So check this out. Thanks for watching and have a blessed day.